Hello everyone, Scott Kinney here, First Heritage Mortgage. Hope you're doing well today. Wanted to go through a couple quick items that might be able to help get some of these new buyers, first-time home buyers off the fence. Now is a great time prior to the heat of the market coming, which is coming quick, and before interest rates really move too much. We're already starting to see a slight trend in an increase, but rates are great right now. But here are the two things that I wanted to go through of programs that could be beneficial. Number one, VHDA. They've got a couple things out right now. The MCC Mortgage Credit Certificate Program, which allows first-time home buyers to get a bigger increase in their tax deductibility on their mortgage loans. Again, it's only for first-time home buyers. We can pair it with any loan out there. So it is a great item. If your lenders aren't talking to your buyers about the Mortgage Credit Certificate Program, the MCC, then your buyers are missing out on a few $1,000s. Second thing is VHDA. We are now one of their preferred lenders, so we're actually the second largest lender of VHDA loans in Virginia. And what that does is they've opened it up so that we can now do their infamous 97% No MI program. Now this program is not just for first-time home buyers. You just can't own a home at the time that you're using this loan. So keys on that 97% No MI, that's a program in which you need a 660 credit score and you need to keep your debt to income ratio at 45% or less. So great program for those individuals who say they don't have any money. Lets them in with one of the lowest down payments available with no mortgage insurance. And we're talking pretty good rates here. We're talking rates at about 4.375. And it doesn't matter if you're at a 660 credit score or an 850 credit score, you get the same rate with VHDA. One of the beauties of the program. So keep that in mind. That'll help qualify some of your buyers to a little higher amount. The second item that they have available is the free grant funds. We've just recently been notified, and I sent out an email, I think yesterday, to let everyone know that the grant funds are now coming available. Of course, they were available at the end of last year, and they extended them a little bit. We've been waiting with bated breath for them to become available again. We now understand any new locks, new registrations with VHDA, starting March 14th, will be available for these grant funds. Now this is free money. There is no repayment. It is not a second trust. Those grant funds will allow a client to basically get 97% financing and use 3% down from them and get really 100%. Great program. You can pair with FHA, and in that case they raised the grant funds to 3.5%. Last year they had greater limitations on income limits. The income limits for those grant funds was less than the income limits placed on VHDA loans. Now they're pairing with their matching. So the VHDA limits, which can be up to $120,000, $140,000, depending on household size, can qualify for that program. It's no longer limited as it was last year to $86,500. The other key thing that's taken place, VHDA only uses the borrower's income. In the old days, VHDA used household income. So even if a spouse was not on the loan, we looked at tax returns. If their income was there, it was calculated towards your gross income. Now they are only and solely looking at borrower income and does it stay within the limits. So typically now, if you're looking at $120,000 income, that's going to fit a whole lot of first-time home buyers in this area. So those are two great things to take and be aware of. A last item I wanted to throw out to you is a change that's going to be coming in the middle of the year. Sometime mid-2016, Fannie Mae has notified us that they are going to be switching their automated underwriting systems to take into account what's called trending credit data. Now, trending credit data is going to look at the last 24 months, and it's actually going to tell lenders what the balances were on each of those accounts over the last 24 months and what was the payment made. And what this is going to do, it's going to break down borrowers into two categories. You're either a revolver, and a revolver means they have credit card debt and they're just paying the minimum every month, or they are a transactor. A transactor is someone that runs their credit card debts up, but they pay it off in full each month. So that is, of course, higher risk for those revolvers. They have low balances, but they're always just paying the minimum on the credit card debt. So what we're expecting is the automated systems will look at this data and will see that maybe someone with low credit scores is a better risk than someone else because they are a transactor and they actually pay off their credit cards every month in full, versus that person with maybe a little higher credit score who, pays the minimum. So things to be aware of. Now is the time to start telling our borrowers and home buyers that this is coming into effect, and it's going to look back at the last 24 months. So the sooner they start changing their credit payment history, the better. For the moment, this is not going to affect credit scores. It's going to just solely be the automated underwriting system and approving of loans. And they're hoping that this may approve more loans versus restricting them. So be aware, have your clients give me a call. Be happy to tell them exactly what they need to do to meet the needs and put them in the best position financially for the future to be able to obtain the house that they desire. Thanks. That's it for now. Hope you have a great day. Call me soon. Bye-bye.